The U.S. stock market took a nosedive this week.
It seems counterintuitive.
Good news about jobs sending the market down. Let's explore those forces at play.
The December jobs report showed a very substantial 256,000 new jobs added, exceeding predictions by over 100,000.
So the unemployment rate, where did that land?
The unemployment rate fell to a low 4.1%.
With key sectors, I imagine, showing some pretty significant gains.
Healthcare, retail, and government sectors led the way.
And this unexpected strength, I imagine, is creating a little bit of a dilemma for the Federal Reserve.
It most certainly is.
So the Federal Reserve has been trying to stimulate the economy, we know, with these interest rate cuts. Is this strong jobs report going to change their strategy?
The Federal Reserve might delay further interest rate cuts or even raise rates to control inflation.
To control inflation.
This uncertainty has made investors nervous, causing them to sell stocks.
And I imagine that's driving down major indices.
Driving down major indices like the Dow Jones S&P 500 and NASDAQ.
The yield on the 10-year U.S. Treasury note also jumped to 4.76%. So what does this tell us?
The surge in the 10-year Treasury yield indicates that investors are worried about inflation and the potential for higher interest rates in the future.
Yeah.
Essentially, they are demanding a higher return for lending money to the government.
Because they perceive greater risk.
Precisely.
Makes sense. Analysts seem to be divided on what the Federal Reserve will do next.
Some analysts, like Goldman Sachs, believe rate cuts are still likely.
Okay.
However, Bank of America predicts the rate-cutting cycle has already ended.
So it's a difficult situation.
It is a very difficult situation for the Federal Reserve to navigate.
What does this strong job market mean for businesses and consumers on the ground?
Businesses are facing higher labor costs due to the competitive job market. Consumers may have to contend with potentially higher borrowing costs for mortgages, car loans, and other forms of credit.
We also have President-elect Trump's proposed tariff policies, adding another layer of uncertainty to the economic outlook. How might this impact the situation?
The proposed tariffs could potentially impact economic growth and international trade.
Adding to the already complex economic picture?
Exactly.
The markets are reacting to this confluence of factors.
Leading to the recent volatility, this final jobs report of 2024 demonstrated that both the economy and hiring expanded at a solid pace.
Even despite interest rates significantly higher than pre-pandemic levels.
Yes. This economic strength has implications for the Federal Reserve's approach to borrowing costs.
The Federal Reserve had previously reduced rates 3 times last year. Were they concerned about slowing hiring and growth?
The Federal Reserve's rate cuts were partly driven by concerns about a potential economic slowdown.
But now we are seeing these robust job figures that suggest a shift.
These figures suggest a shift in the economic landscape.
It appears the U.S. economy is transitioning into a new phase.
It is.
What are the defining characteristics of this phase?
The U.S. economy is entering a post-COVID phase, characterized by steady growth, elevated interest rates, low unemployment, and slightly increased inflation.
This transition presents both opportunities and challenges.
It does.
We know that high interest rates can make it difficult for Americans to purchase homes, cars, or appliances.
It can.
Have we seen any impact on mortgage rates?
Mortgage rates have experienced consecutive increases, reaching their highest point since July.
And this is a direct consequence of the Federal Reserve's efforts to combat inflation.
By raising interest rates, yes.
Despite these efforts, the economy has exceeded expectations.
It has.
How has consumer spending been affected?
Companies have maintained hiring practices, and consumer spending has persisted.
Despite higher interest rates.
Despite higher interest rates, the economy has continued to expand.
Showcasing its resilience.
Yes.
The U.S. gross domestic product has grown at a robust annual rate of 3% or more in 4 of the past 5 quarters.
It has.
Has inflation declined?
Inflation has declined from a peak of 9.1% in June 2022 to 2.7% in November.
So this decrease in year-over-year price increases.
This decrease provided the Federal Reserve with the confidence to implement 3 rate cuts in the last 4 months of 2024.
It appears that the Federal Reserve is taking a more cautious approach to rate cuts this year.
They are.
What is their current projection?
Federal Reserve officials now project only 2 rate reductions in 2025.
That's bad.
This is down from the 4 rate cuts anticipated in September.
So this shift in their projections, what do you think is causing that?
The shift is attributed to the stalling of progress in combating inflation, which remains above their 2% target.
And we know that many businesses are still actively seeking workers to fill open positions.
They are.
Are healthcare providers facing any specific challenges?
Some healthcare providers are experiencing challenges in finding skilled clinical workers.
And to address this, I imagine that they're doing a few things.
To address this, they are raising pay and offering tuition assistance to employees to encourage career advancement within their organizations.
Makes sense. The job search can be difficult for some individuals, even in a strong job market.
It can.
What factors contribute to this difficulty?
While some companies are experiencing hiring success, others struggle to find suitable candidates.
And that means
This can lead to extended periods of unemployment for certain job seekers, despite the overall strength of the job market.
we saw the stock market experience a significant decline on Friday.
We did.
What caused this decline?
Investors reacted to the implications of a better-than-anticipated jobs report, causing a decline in the stock market.
This unexpected development raised concerns about the future trajectory of interest rates. The Dow Jones Industrial Average plummeted by nearly 700 points.
It did.
Did other major indices experience declines?
The S&P 500 and the tech-heavy NASDAQ composite experienced declines of 1.5% and 1.6% respectively.
So this sell-off in the market was triggered by the strong job growth reported for December.
It was.
The addition of 256,000 jobs exceeded economists' expectations.
It did.
How did this impact investor expectations regarding interest rate cuts?
The robust job growth diminished hopes for further interest rate cuts by the Federal Reserve.
So investors are now closely monitoring the Federal Reserve's actions.
To assess the potential impact of this strong jobs report on monetary policy decisions.
So we have this possibility of a shift in the Federal Reserve's stance on interest rates, which is introducing some uncertainty into the market. What other factors are contributing to investor anxiety?
Concerns over President-elect Donald Trump's proposed tariff policies have also contributed to heightened investor anxiety.
So this unease, we're seeing it reflected in the surge in bond yields.
Lior.
The yield on the benchmark 10-year U.S. Treasury note rose to 4.76%.
It did.
Are market participants unified in their opinions on the Federal Reserve's likely response to this economic strength?
Market participants are divided in their opinions.
How so?
Some analysts believe the Federal Reserve will maintain its current course of rate cuts, while others anticipate a pause or even a potential reversal in policy.
So this divergence in viewpoints underscores the complex challenges faced by policymakers as they navigate an evolving economic landscape.
It does.
The Federal Reserve must balance robust job growth with concerns about inflation.
They must.
This jobs report has highlighted the intricate interplay between economic data and investor sentiment. Until next time, goodbye.